Welcome, future financial wizards, to a world where market downturns aren't the end of your investing journey, but the beginning of something extraordinary. Imagine the stock market as a thrilling roller coaster ride filled with exhilarating highs and heart-stopping lows. The secret to enjoying this ride? It's all about strategy and resilience. Today, we're diving into the art of thriving when stocks go down. We'll explore everything from emotional resilience to strategic selling, and even how the gig economy can be your financial lifeboat. But before we embark on this journey, let me ask you, are you ready to turn market chaos into your greatest opportunity? Whether you're contemplating diversifying your income, investing in stability, or simply cutting back on those daily lattes, you're about to discover how to navigate these turbulent times with confidence and grace. So, grab your metaphorical seatbelt and let's transform uncertainty into empowerment. Stick around, because by the end of this video, you'll be equipped with the tools to not just survive, but thrive in any market condition. Chapter 1. Understanding Market Volatility. Hello fellow investors. If you've been keeping an eye on the markets, you might be feeling a bit uneasy about your investments. We get it. Market downturns can make it seem like your financial future is hanging by a thread, but fear not. We're here to guide you through this roller coaster ride and show you why it's not all doom and gloom. Market anxiety is a common feeling during downturns, but it's crucial to stay calm and informed. Remember, even the most seasoned investors, like Warren Buffett, see opportunity in the chaos. As he famously said, "Be fearful when others are greedy, and greedy when others are fearful." So, let's dive into how you can thrive when stocks take a nosedive. When the stock market takes a hit, it's easy to feel like you're on a sinking ship. But let's flip the script and see this as an opportunity. Think of it as a clearance sale for the stock market. Prices are down, and it's your chance to pick up some long-term investment opportunities at a discount. A Wells Fargo study found that the average 13-month return after a bear market is a whopping 43%. So, if you have the patience to buy and hold, you could see substantial gains. Just be cautious of the dead cat bounce, where a temporary recovery is followed by further declines. But if you can weather the storm, the rewards can be significant. Now, let's address the elephant in the room: mortgage rates. They're currently at 6.7% and expected to drop further. So, while the stock market might be giving you a headache, your mortgage payments could be a bit easier on the wallet. It's like finding a silver lining in a cloudy sky. But is this a market correction or a looming recession? On one hand, the Federal Reserve is maintaining high interest rates, and there are signs of weakness in the job market. On the other hand, corporate earnings are strong, and analysts predict potential rate cuts. It's like trying to predict the weather. Sometimes you just have to wait and see. The truth is, market downturns and recessions are a natural part of the economic cycle. They can be scary, but they also present opportunities for those who are prepared. So, don't let fear drive your decisions. Instead, approach your investments with a clear head and a long-term perspective. Remember, when it comes to investing, patience is a virtue. Stay informed, stay calm, and seize the opportunities that come your way. And most importantly, don't let your emotions dictate your actions. Think of it like going grocery shopping on an empty stomach. You're more likely to make impulsive decisions that you might regret later. So, take a deep breath, stay rational, and let's navigate this market together. You've got this. Chapter 2. Emotional Resilience in Investing. As we continue from our previous discussion on market volatility, let's delve into the emotional resilience needed to navigate the unpredictable world of investing. The stock market can feel like a roller coaster, with its ups and downs leaving you feeling queasy. But here's the secret. It's not about eliminating emotions, it's about managing them effectively. When the market takes a dive, panic selling is a common reaction. It's like jumping off the roller coaster mid-loop, rarely a good idea. Instead, embrace the ride and make decisions based on logic, not fear. Emotional resilience is your best ally here, allowing you to stay calm and collected even when the market seems to be in free fall. A key strategy for maintaining your cool is having cash reserves. Think of it as your financial safety net, a cushion for those unexpected market drops. Financial planning during a recession means keeping about 15 to 20% of your portfolio in cash. This isn't about stashing bills under your mattress. It's about being prepared. When the market dips, your cash reserves give you the flexibility to seize opportunities, like buying stocks on sale, without the stress of financial pressure. Now, let's talk about the art of riding it out. Dollar cost averaging is a strategy that can help smooth out the bumps. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when they're high. This approach helps reduce volatility and lowers the average cost per share. Remember, time in the market beats timing the market. Your investments will grow more valuable if you hold them for the long term, rather than trying to predict every twist and turn. Emotional resilience in investing is about accepting that change is inevitable. It's about learning from each market swing and using those lessons to grow stronger. As you build this resilience, you'll find that setbacks are just stepping stones to greater success. So buckle up, keep your eyes on the horizon, and enjoy the ride. You've got the tools to thrive, even when stocks go down. Chapter 3: Long-term investment strategies. Now let's delve into long-term strategies that can help you thrive even when stocks go down. Previously, we discussed emotional resilience and the importance of managing emotions to avoid panic selling. Now, let's focus on riding the market roller coaster and protecting your career during economic downturns. Like I said in the previous chapter, investing is much like a roller coaster ride. There are exhilarating highs and stomach-churning lows, but the key to success is staying strapped in for the long haul. One effective strategy is dollar cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This approach allows you to buy more shares when prices are low and fewer when they're high, smoothing out the bumps and reducing overall volatility. Remember, time in the market beats timing the market, and your investments will grow more valuable if you hold them long term. While navigating these financial ups and downs, it's crucial to protect your career. Economic downturns often bring job insecurity, so now's the time to make yourself invaluable at work. Upskill by taking extra courses, volunteer for new projects, and demonstrate why your company can't succeed without you. But be strategic. If your company shows signs of instability, consider exploring opportunities with resilient firms that thrive even in tough times. Some companies still compete for top talent during downturns, offering competitive salaries and benefits to ensure growth and stability. In the investment world, it's also important to trim the fat from your portfolio. This isn't about panic selling, it's about making strategic decisions. Sell off underperforming stocks to free up cash for better opportunities. Rebalancing your portfolio can prevent losses and prepare you for new investment prospects. Even big-name investors like Berkshire Hathaway have trimmed their holdings to capitalize on future opportunities. It's about being proactive and strategic, not reactive. Ultimately, thriving when stocks go down requires a blend of patience, strategy, and adaptability. By staying informed and making calculated decisions, you can navigate the market's twists and turns with confidence. So keep your eyes on the horizon and remember that every downturn is an opportunity in disguise. Chapter 4: Strategic Selling and Portfolio Management. As we transition from discussing long-term investment strategies, let's explore the art of strategic selling and portfolio management. In the previous chapter, we touched on the importance of staying invested for the long haul and upskilling to protect your career. Now, it's time to focus on how to effectively manage your investments and block out the noise that can derail your financial goals. In the world of investing, strategic selling is like pruning a garden. You trim the underperforming stocks to allow the healthier ones to thrive. This isn't about panic selling, it's about making calculated decisions to rebalance your portfolio. By doing so, you free up cash to seize new opportunities that align with your long-term goals. Remember, even seasoned investors like Berkshire Hathaway occasionally trim their holdings to capitalize on future prospects. But amidst all this, the constant barrage of news and opinions can make you second-guess your strategy. It's like having a radio blaring in your ear while you're trying to focus on a complex task. To truly thrive, you must learn to block out this noise. Focus on your long-term objectives rather than reacting to every market fluctuation. Create a mental filter for the information you consume, remembering that not all advice is worth following. In these uncertain times, consider supplementing your income through the gig economy. It's a thriving sector during downturns, offering flexibility and additional cash flow. Whether it's freelance work in graphic design, writing, or even driving for rideshare apps, the gig economy provides a safety net when traditional job markets are unstable. Embrace this opportunity to diversify your income streams and enhance your financial resilience. Lastly, take a hard look at your spending habits. It's easy to fall into the trap of inflation, where spending creeps up without you noticing. Be vigilant and regularly assess your expenses to ensure you're not overspending. Trimming unnecessary costs can bolster your emergency fund, providing peace of mind during economic downturns. By mastering strategic selling, filtering out market noise, and embracing new income opportunities, you'll be well equipped to navigate the financial landscape. Remember, every downturn presents a chance to reassess and strengthen your financial position, so stay focused, stay informed, and keep moving forward. Chapter 5: Diversifying Income and Investments. Previously, we discussed the necessity of trimming underperforming stocks and blocking out market noise. Now, it's time to explore how the gig economy and mindful spending can bolster your financial stability during uncertain times. In today's fast-paced world, relying on a single income stream is like putting all your eggs in one basket. The gig economy offers a flexible and lucrative way to diversify your income. Whether it's freelance writing, graphic design, or driving for a rideshare service, these opportunities provide a financial cushion when traditional job markets falter. Embracing this flexibility not only supplements your income, but also enhances your financial resilience. However, it's not just about earning more, it's about spending wisely. Economic downturns are the perfect time to reassess your spending habits. It's easy to fall into the trap of lifestyle inflation, where small indulgences gradually become the norm. By regularly evaluating your expenses, you can identify areas to cut back, freeing up cash to bolster your emergency fund. This proactive approach ensures you're prepared for any financial surprises that come your way. Remember, diversifying your income and investments isn't just a strategy. It's a mindset. It's about embracing change and seeking out new opportunities, even when the market seems bleak. By capitalizing on the gig economy and cutting unnecessary spending, you create a robust financial foundation that can withstand any storm. As you navigate these strategies, keep in mind the power of storytelling. Just as the rule of three enhances narratives, diversifying your financial approach creates balance and stability. So, stay curious, stay adaptable, and continue to build a future that's as dynamic and resilient as you are. Chapter 6: Safe Investment Alternatives. As we transition from diversifying income and investments, let's explore safe investment alternatives that can provide stability during market downturns. Previously, we discussed the importance of leveraging the gig economy and mindful spending. Now, let's delve into how bonds and entrepreneurship can serve as strategic moves in uncertain times. When the stock market feels like a turbulent sea, many investors fly to safety with bonds. Bonds are like the life jackets of the investment world, more stable than stocks, but not without their own risks. As stock prices drop, bond prices often rise, making them an attractive option. However, timing is crucial. Jumping into bonds when prices are high without understanding their nuances can be a misstep. Bonds are more liquid than cash, but their value can decrease when interest rates rise. A balanced approach, such as allocating 30% of your portfolio to bonds, can offer a cushion against large stock market drops. Now, let's talk about launching a business. It might sound counterintuitive, but starting a business during a downturn can be advantageous. Economic slowdowns weed out weaker companies, creating opportunities for new ventures. Assets are often sold at discounted prices, allowing new businesses to acquire high-quality equipment affordably. Plus, with fewer investment opportunities available, attracting investor attention becomes easier. It's a chance to innovate and establish a foothold before the inevitable economic upswing. Investing in liquid businesses is another strategy. Companies with strong financial reserves can weather economic storms better than those without. Look for firms with solid balance sheets and ample cash reserves, like Apple or JP Morgan Chase. These companies can continue operations even when revenue dips, unlike those with limited liquidity, such as Blockbuster or Sears. By researching a company's financial health, you can make informed decisions about where to invest your money. Incorporating these safe investment alternatives into your strategy can help you navigate uncertain times with confidence. Remember, every downturn presents an opportunity to reassess and strengthen your financial position. Stay informed, stay strategic, and continue building a resilient future. Chapter 7: Investing in Stability. Previously, we discussed the strategic advantages of bonds and entrepreneurship during downturns. Now, let's delve into how companies with strong financial reserves and assets like gold and silver can offer security in uncertain times. Investing in liquid businesses is like choosing a sturdy ship to weather a storm. Companies with robust financial reserves, like Apple or JP Morgan Chase, can navigate economic turbulence more effectively than those without. These firms have the cash flow to sustain operations even when revenues dip, making them reliable choices for investors seeking stability. By examining a company's balance sheet and liquidity, you can make informed decisions about where to allocate your resources. Meanwhile, precious metals like gold and silver have long been considered safe havens during economic uncertainty. Their inherent value and scarcity make them attractive options for preserving wealth. Unlike stocks, which can fluctuate wildly, gold and silver tend to hold their value, providing a buffer against market volatility. As Ashish Shah from Goldman Sachs noted, 2024 is shaping up to be a significant year for bonds, but precious metals remain a timeless choice for those seeking to diversify their investments. However, while backing precious metals can be a wise move, it's crucial to avoid falling into bad debt. During downturns, the temptation to defer debt repayment can be strong, but maintaining a clean credit history is vital. Defaulting on payments can limit your financial flexibility when you need it most. Instead, focus on building an emergency fund and managing your finances prudently. Incorporating these strategies into your investment approach can help you build a resilient financial foundation. By investing in liquid businesses and precious metals, you can safeguard your wealth and navigate economic challenges with confidence. Remember, every investment decision should be made with a clear understanding of your long-term goals and the current market landscape. Chapter 8: Preparing for the Future. As we wrap up our exploration of strategies for thriving when stocks go down, let's focus on preparing for the future. Previously, we discussed investing in stability through liquid businesses and precious metals. Now, let's dive into avoiding bad debt and taking proactive measures to secure your financial future. Think of this economic scare as a wake-up call. It's like the universe nudging you to get your financial ducks in a row. Avoiding bad debt is crucial, especially during downturns. Maintaining a good credit standing ensures you're prepared for unexpected expenses without relying on high-interest loans. Remember, bad debt is like a leaky boat. It can sink you faster than you think. But beyond debt management, it's time to answer the call by investing in yourself. Upskilling and diversifying your investments are preventative measures that might not seem thrilling now, but will protect you in the long run. Think of them as the financial equivalent of eating your vegetables necessary for growth and resilience. Whether it's learning a new skill or expanding your portfolio, these investments in yourself are your best defense against future economic challenges. For many, the 2008 financial crisis is a haunting memory. Millennials watched their parents struggle, homes being sold, and retirement funds dwindling. These experiences highlight the importance of having a solid plan. By taking steps now, like building an emergency fund and diversifying your investments, you can thrive even when the economic landscape shifts. As we conclude this journey, remember that every downturn is an opportunity to reassess and strengthen your financial position. Stay informed, stay proactive, and embrace the challenges as opportunities for growth. With the right strategies in place, you'll be well equipped to navigate whatever the future holds. As we close this chapter on navigating the turbulent seas of the stock market, let's take a moment to reflect on the journey we've shared. From understanding market volatility to mastering emotional resilience, from strategic selling to investing in stability, we've explored a wealth of strategies designed to help you thrive when stocks go down. It's been a roller coaster, hasn't it? But remember, it's not about avoiding the ride, it's about learning to enjoy it, bumps and all. Now, as you stand at the crossroads of opportunity and uncertainty, Ask yourself this: are you prepared to turn today's challenges into tomorrow's triumphs? It's a question that echoes through every chapter we've covered, from diversifying your income streams to backing precious metals, and from avoiding bad debt to embracing the gig economy. Each strategy is a tool in your arsenal, ready to help you build a resilient financial future. As you ponder this, remember that every step you take is a step toward empowerment. Whether you're upskilling, investing in liquid businesses, or simply cutting back on unnecessary spending, you're crafting a narrative of success. It's a story where you're the hero, armed with knowledge and ready to face whatever the market throws your way. So keep your eyes on the horizon and your feet firmly planted on the ground. Stay curious, stay adaptable, and most importantly, stay true to your financial goals. And as you continue this journey, remember that the power to thrive lies within you. Thank you for joining us today. If you found value in this video, don't forget to like, subscribe, and share your thoughts in the comments. We'd love to hear how you're preparing to turn market downturns into opportunities. Until next time, keep thriving and keep investing in your future.